Hi, everybody. I'm very excited again today. We've got a special guest here today. Her name is Sarah Drury. Sarah and I have gone back a couple of years. I've helped you as a realtor, and you have definitely come in and really made some big changes for clients of mine that couldn't get approvals with other sources. And you've come in and been the big hero and saved the day. So you being as knowledgeable as you are, I wanted to interview you today, and hopefully you can give our watchers some education that most people are always asking these similar questions. So let's pick your brain and share the info that you have. So Sarah,
Okay, sounds good.
you are with Dominion Lending, correct?
Yep, I'm with Dominion Lending Centers, and I've been in the field for 6 years now.
Wow, okay. And you actually live in Hawkestone also, correct?
Yep, that's correct. So I'm a County of Simcoe resident. I know the area very well.
Perfect. Well, that's kind of why I'm also interviewing, aside from the fact that you've been so great to me in my past and my clients, but I'm also the community influencer for Oro-Medonte. So I'm really all about promoting local people, local businesses. So it's a perfect match.
And
Exactly.
knowing the area, like you know the area like the back of your hand. And again, you're just so professional.
Thank you.
And my clients always walk away happy and feel like they're entrusted in you. They have that sense of comfort with you.
Thank you. And likewise with you.
Thank you.
So first question I want to ask you, and this is funny, I hear this a lot, and I also learned from my end because I also wrote my mortgage certificate.
Right.
What's the big difference between going into your bank, having a consultation and getting a mortgage through a bank consultant versus working with someone like you as a mortgage broker?
That's a great question, and I actually get asked that a lot too. So some of the key points is coming to a broker. We pull your credit once, and then we have the opportunity, especially with my brokerage, because it's one of the largest in Canada. We can shop up to 115 different banks, credit unions, monolines to help you get qualified. So it's not just what happens is you go to the bank says no. I might get a no, but then I have many opportunities to find you a yes.
For other sources.
Yeah, absolutely. And the other thing is rates. And it's not always about rate, but it's obviously a huge factor. So rates with a broker are generally lower because we don't have the same overhead that the banks do. So we're working directly for you. So we can get you the best rate on the market. The banks have huge overhead and expenses. And the way that they recap that is through higher interest rates. So you're paying for them to pay their expenses.
Right.
So lower rates with brokers, and we have many more lenders to work with.
Got it. And is it true when you go in and deal with a bank mortgage consultant, they technically have to sell you what their bank is offering because they're an employee of the bank, correct?
That's an excellent question. Excellent. And I'm going to touch on fixed versus variable for that question. So, and again, as a general rule of thumb, bank employees get paid more to sell you a fixed rate mortgage than they would a variable rate mortgage.
Okay.
And clients have been conditioned to think that variable is not the way to go. Variable is the way to go. And the reason why is because you have so much more flexibility and control over your mortgage. You get the mortgage paid down faster. If you ever need to leave that mortgage, let's say you're moving, you only ever have a 3-month interest penalty.
Oh, okay. That's a big factor.
Down the road.
Yes.
But that being said, some clients have to go into a fixed rate because certain clients, they need to have that proper budget. But I usually put clients into a variable rate because it's better for the client.
Got it. So those are very good points. And these are things that a lot of people aren't aware of. So thank you for sharing your view on that and the facts on it.
No problem.
So another interesting one, which I come across too, is what is the difference between mortgage insurance and having life insurance? Because this is a big one.
So I love this question. And part of my job is also about education and helping people understand what a mortgage is, what it entails, and everything else that goes along with it.
Right.
That being said, is protecting your mortgage, protecting you and your family. So if you're, let's, as an example, you go to like a Schedule A bank, I won't name names, they sell you a mortgage and then they sell you the mortgage insurance. The mortgage insurance is not the same as term life insurance. The mortgage insurance will only cover a portion of that mortgage, hypothetically speaking. If at the time of, let's say, death, the mortgage can only be paid down to what the balance is. So it's not the full amount, and it's at the discretion of the bank. So let's say you pass away from a heart attack. That's a bank's easy out. And the reason why term life insurance can counteract that is because you're going to get underwritten up front. So you're going to have all your medical and health determined up front.
Yes.
So you can't have a no if you pass away, right? So having term life insurance, you're going to get more coverage. It's going to be cheaper, and you're going to get underwritten up front. The banks won't offer you that. They can offer you that, but they're not going to be forthcoming with that.
No.
So generally, the term life insurance and like life insurance is better for you and your family because you're going to have larger coverage. It's cheaper, and it's going to be underwritten up front. So at the time of death, you have that peace of mind.
Got it. And I know there's a lot more to expand on that, but maybe we'll cover that in another session another time. But that's a big one.
On that.
Yeah, absolutely. So another big one, I'm really bringing up the big points that I seem to come across a lot is, what about people like yourself and me who are entrepreneurs and we're self-employed? How do you approach somebody that's self-employed, and what tips do you have to help people take the first steps of getting mortgage approvals for them?
So I think for everybody, like a pre-approval, come to us and we'll underwrite your deal. We'll take a look at you and we'll look at the finances, the income, the credit, just the overall picture. From there, we can decide which avenue we're going to take. So just because you're self-employed doesn't mean you can't have excellent rates. We have many clients who are self-employed on the A side with Scotia, with TD, because we can look at that file and make it work. If we have a 2-year average and you've got that strong credit and you're reporting on your line 150, we have every opportunity to place you on the A side. Let's say you get declined and we can't place you on the A side. That's fine. We'll place you on the B side, and we call them like alternative mortgages. And that whole field has dedicated lenders for the self-employed client. Rates are generally a little bit higher. Right now, we're looking anywhere between 3 and 4%. So still competitive and much more flexibility. So we can think outside the box on the B side. An example for that would be, we'd use like the stated income program. We can use 6 months of banking history, look at your credit, and look at whatever financials you can provide us, and come and get a solution for you.
Okay.
So there's still so many options for the self-employed client.
Which is good to know, because in the past it's been extremely difficult for self-employed because they are, of course, self-employed. We try to write our income down as low as we can with our expenses, and then
and
it goes against us.
And that's where we can use like the stated income program. That's okay. Like if you want to write your expenses down, go for it, because we can think outside the box and qualify it in different ways.
Good. This is good to know.
Yeah.
Especially for me.
Yeah, me too.
And also, you said something at the beginning of that question, the term pre-approval. Can you clarify that a little bit better? Because there's so many misunderstandings between approval and pre-approval, guarantees, not guaranteed. Can you clarify?
Yeah. So pre-approval can be misleading. So if you go to the bank for a pre-approval, generally they just take what you tell them. So I make this amount of money, they'll pull your credit and say, Jane Doe, you're qualified for up to $500,000. That's so misleading, because it's only taking into consideration a portion of that application. The pre-approval is part you, so part your income, part your credit, but then you're missing the property itself. So we can give you a pre-approval. We can tell you you're qualified up to X amount, but it's not a guarantee because we haven't seen the property. And what that means is we have to submit it to the bank. So let's say we submit it to Scotiabank. Scotiabank has to say yay or nay on that property and do their due diligence on that property. And sometimes what could happen or could arise, let's say that property had a lien against it, or maybe there was severe water damage. We don't know until we see the property. So if we say to you, you're pre-approved for $500,000, you go put an offer in, and it gets declined when it gets to the bank, we've only done half of our job. So I just base it on what you can qualify for. And I always tell clients it's also dependent on the property.
Right.
So
And this is probably something we're seeing a lot in the last few months, and probably also relating back to 2017 and 2016. Yep. But there's such an overinflation on price points, of sold price points, that when the bank comes in to do their approvals on the property, they're not necessarily, the appraisal's not really coming through where it's supposed to be. Yep. So the value's been way overpaid for, and the bank might just say no on that. Right? Does that happen?
And we've seen that happen too. So in markets like this, you have to be careful and you have to do your due diligence and know what you're getting into. But having a realtor such as yourself who knows what the market's like, to be able to tell the client, like, hey, this is what we're up against, helps the client make decisions on that. And then having a broker on this side saying, like, okay, well, I can tell you how much you're qualified for, but just be aware, like, yeah. We don't ever want to give false hope, and that you and I think are really good on that, and telling people, right up front.
Absolutely. Never want to see someone in a bad situation.
Yeah.
Another big one, land transfer tax. People always get confused. Is it when you buy a house? Is it when you sell a house? And how is that calculated? Could you tell us?
Okay, so land transfer tax is another good one. I love this question. So if you're a first-time home buyer, you're entitled to that rebate. So you don't actually see the cash in hand. That happens at the time of the lawyers, and the lawyer provides that rebate for the land transfer tax.
Okay.
If you're not a first-time home buyer, then you have to pay that land transfer tax. So what I tell clients is, if you're not a first-time home buyer, you need to make sure we factor that amount into our closing costs.
Right. Because
I've seen deals where they haven't been educated on the land transfer tax and said, like, hey, you need to have this $7,000 for land transfer tax, and we don't have it because we're short. So it's part of our closing costs, and it's important to know that. Okay. So I guess being a first-time home buyer, it's going to be considered a rebate. And if you're not a first-time home buyer, you need to incorporate that into your closing costs.
Right. So it's always on the buying end.
Yeah.
Okay. Good. Because there's always confusion with that. Always people are not sure which end it's on. I guess the best thing to remember is always know if you're going to be buying something, there's always tax. So keep that in mind as a buyer. Help people remember that. Yeah.
Exactly.
So what about just kind of closing here? Can you give our viewers some do's, don'ts, and some tips that they really need to try and follow or keep in mind when getting into the mortgage approval process? And also, most important, I see this all the time, is people go and get a new car, or they buy new furniture, and now they have all this additional credit card debt, and it throws up their ratios. So that's a big one. Yep. Don't do it.
So I tell clients, once we have that purchase in place and we know what we're up against, don't open new credit. Don't go buy a new car. Don't leave the country on vacation. Stay current until you have the keys in your hand.
And then you can break free.
Then you can break free, because you don't want to jeopardize the file, because a couple days prior to closing, the bank can review your credit bureau. And if they see all this new credit, they can decline your file on that.
Yeah.
So until you have those keys in hand, don't go shopping. Keep your money for the down payment, and keep your money in your savings account.
That's right. Yeah. Wonderful. Well, thank you very much, Sarah. This was so informative, and I'm sure this will really help clear things up for people.
Yeah, definitely.
We really appreciate your time. And again, anybody that's looking to have a consultation or a phone call, you can see Sarah's number and emails on the screen here. So feel free to give her a shout. Again, it's Sarah Drury at Dominion Lending, and hosted by myself, Janine Dezotti. I'm your local realtor with Engel Volkers. And I hope everybody has a great day. Thanks so much.